2. Today we're breaking down the absolute essentials that every beginner needs to know. We'll cover 4 key concepts: PIPS, lots, leverage, and how to calculate your potential profits. By the end of this video, you'll have a solid foundation to understand how the Forex market really works. So, grab a notebook and let's get started on your trading journey. The word PIP stands for percentage in point or price interest point. Simply put, it's the smallest price move that a currency pair can make. Think of it as one unit of measurement. For most currency pairs, like the euro versus the US dollar or the British pound versus the US dollar, a pip is the 4th decimal place. For example, if the EU or USD price moves from 1.1050 to 1.1051, that's a 1 pip move. It's that tiny, or pairs involving the Japanese yen, like USD JPY. A pip is the 2nd decimal place, so if the price of USD JPY moves from 110.45 to 110.46, that's a 1 pip increase. Why are pips so important? Because they are the fundamental unit for calculating your profits and losses. Every pip your trade moves in your favor means profit, and every pip it moves against you means a loss. Understanding pips is the very first step to measuring your trading performance. In Forex, you can't just trade $1 or €1. Currencies are traded in specific quantities called lots. A lot is simply a standardized unit of currency. Understanding lot sizes is crucial because it determines the size of your trade, which directly impacts your potential risk and reward. First, we have the standard lot. One standard lot is equal to 100,000 units of the base currency. So, if you're trading the EUR-USD pair, one standard lot is 100,000 euros trading. With standard lots means each pip move is typically worth about $10 US. This is usually for more experienced traders with larger account balances. A mini lot is 1/10 the size of a standard lot, which means it's 10,000 units of the base currency. Using our EUR-USD example, one mini lot would be 10,000 euros. With a mini lot, each pip move is worth about $1 US. This is a popular choice for intermediate traders who are ready to move beyond the smallest size but aren't quite ready for a standard lot. As you might guess, a micro lot is even smaller. It's 1/10 of a mini lot, which equals 1,000 units of the base currency. So, one micro lot of your USD is 1,000 euros. For a micro lot, each pip move is worth about 10 cents. Micro lots are perfect for beginners. They allow you to trade with real money but with significantly lower risk, giving you a chance to practice your strategy and get a feel for the market without risking a large amount of capital. Choosing the right lot size for your account balance and risk tolerance is a key part of money management and trading, which is one of the most powerful and riskiest tools in Forex. Leverage. What is leverage? In simple terms, leverage allows you to control a large amount of money using a very small amount of your own capital. At SLE, getting a loan from your broker to open a much larger trading position than your account balance would normally allow. Brokers offer leverage in ratios like 50-1, 100-1, or even higher. A 100-1 leverage means that for every $1 in your account, you can control $100 in the market. So, with just $1,000 of your own money, you could open a trade worth $100,000, which is a standard lot. 2. If you open a $100,000 position and the market moves in your favor by just a small amount, your profit will be calculated based on the full $100,000, not just your initial $1,000. This is what makes it possible to earn significant returns from relatively small price movements. Just as it magnifies your profits, it also magnifies your losses. If the trade goes against you, your losses will also be calculated on the full leveraged amount. This means you could lose your initial investment very quickly. A small negative price movement can wipe out your entire trading account if you're not careful. That's why understanding and respecting leverage is critical. Always use it wisely, and never trade with more leverage than you are comfortable with. Proper Risk management is your best friend when dealing with leverage. Now, let's put it all together and learn how to calculate your profit or loss. This is where the magic happens and you see how these concepts work in the real world. The calculation is actually quite straightforward. But how do you determine the PIP value? The PIP value depends on the lot size you are trading. Let's walk through an example. Let's say you decide to trade one mini lot, which is 10,000 units. For a mini lot on this pair, the value of 1 pip is approximately $1. To find out how many pips you've gained, you just subtract your entry price from your exit price. So, 1.2080 minus 1.2050 equals 0.0030, which is a 30 pip gain. In this case, that's 30 pips multiplied by $1 per pip. Your total profit on this trade would be $30. It's that simple. The calculation is the same. 30 pips multiplied by $1 per pip gives you a $30 loss. This example shows how your choice of lot size directly determines how much money you make or lose for every pip the market moves. By understanding this calculation, you can better manage your trades and set realistic profit targets and stop-loss levels. We started with pips, the smallest unit of price movement in the Forex market, which is how we measure our gains and losses. Then we discussed lots, the standardized trade, sizes standard, mini and micro, which determine the volume of your trades and your risk exposure. After that, we explored leverage, the powerful tool that allows you to control a large position with a small amount of capital, but also comes with magnified risk, too. And finally, we put it all together to calculate profit and loss by multiplying the pips you've gained or lost by the pip value determined by your lot size. My final tip for all beginners is this. Start small. Open a demo account or trade with microlots. Practice identifying pips, choosing the right lot size for your account, and understanding the effects of leverage without risking significant money. Build your confidence and your strategy first. The markets will always be there. Take your time, learn the fundamentals, and trade smart. I hope this breakdown has helped demystify the basics of Forex trading for you. If you found this video helpful, please give it a thumbs up. Then don't forget to subscribe to the channel for more educational content just like this. If you have any questions, drop them in the comments below, and I'll do my best to answer them. Happy trading, and I'll see you in the next video.